All right, the market is closed. There's nobody here but me. I'll wait a few minutes. I just want to tell everybody welcome to Wall Street Wednesday. Let me get this officially down. Wall Street Wednesday. Today is November 25th, day before Thanksgiving. Hopefully all you guys are having a great and wonderful Thanksgiving. So welcome, and I do appreciate you guys showing up when most of you should be actually in the kitchen cooking like I've been doing. So welcome. Got a number of things I want to go over. Hopefully you will find it all very helpful for you. And as I always tell you guys, I got my system open, I've got my iPad open, I've got my laptop open, I got everything open. So basically we can have what we call a full-on day. So bear with me a second. I'll get some information up. And I'm not sure where to start. So since I'm having people join, and all right, let's start with this. Let's start with a couple of things. Let me get some pictures up here. So let me start with this. All right. No, oops, wrong one. Sorry. It's not what I wanted to start with. I wanted to start with this little quote. You guys always hear me say this. I say it all the time. I keep saying it. Part of today's my conversation today is going to be about this. In order to win the game, you have to know the rules. I get so many emails from, and this is a good thing, so don't get me wrong. I get so many emails from what I would call young people that want to know. They want, Professor Milligan, I want to invest in the market. I want to learn how to make money. I'm into it. I'm going to do what I have to do. So it's not like that you guys aren't trying to learn the rules. It's that you're just not getting all the rules. So one of the things I'm going to do is I'm going to spend a little time each time we're on here talking about some of the rules. And once you learn the rules, the game becomes so much easier. So today, when I start talking about the rules, I'm going to talk about options. I'm going to talk about some trades I made, but I'm also going to talk about some options. And also I'm going to talk about, for some of you guys who've been tracking and watching some of the things I've been talking about. And I understand you missed it. In other words, I said this is a buy. I said I'm buying it here. I did what I do. And some of you said, yeah, I follow you, but you didn't do it. And that's okay. You can't make every trade. All right. You can't make, you're going to miss it. You're going to miss some. So the key is after you miss it, what do you do if you miss it? What do you do if you miss the trade? So you like a stock, you find it, what do you do? So we're going to talk about that a little bit today in terms of our rules. The other thing I've been getting a lot of questions on, again, is options. And as I said to you, there's no way that you can cover options in a 5-minute conversation. You just can't. So what I decided to do today was I'm going to try and nibble at it, bit by bit, a little bit each time we're on. So I'm going to start nibbling on that today. So that's my plan. So with that said, first and foremost, let me go here. And do I have it? Of course I don't have it. Of course I don't. Which means, how could that chart not be up there? Oh, there it is. There it is. All right. What you're looking at right now is the VIX, the Volatility Index. Now, you guys have heard a lot about the Volatility Index. You've heard how you can see there are two spikes. And usually those spikes are when the market sold off and it turned out to be great buying opportunities. So the reason why I brought this up is that, as we know, volatility is in the market, but it hasn't really spiked up. There's nothing negative. So VIX hasn't spiked up. And just to do a quick review again, the VIX is a contrarian indicator. When the VIX is rising, real brief, when the VIX is rising, actually, let me back up. The VIX is calculated using 30-day puts in the numerator and 30-day calls in the denominator, all right, for the S&P. So when premiums go up on the puts, typically that means there's heavy put buying. The VIX is going to go up too because the puts actually have a higher value than the calls. And when the market's really bullish, and the market's going well and there's heavy call buying, you'll notice that the VIX is going down and running low. Now, the reason why I say that is if you look at the last, basically since our last spike, the VIX has done two things. One is it's gone down and it's trending down towards the lower Bollinger Band. What that means is that the overall sentiment in the market is they are bullish. Now, how long will this last? The VIX won't tell you how long it lasts. I can tell you, though, that the overall market right now is bullish. And since the VIX uses 30-day options, you can figure that the market's saying over the next 30 days, they think that the market's going to be bullish. All right, so I wanted to bring that up again. Just let you know where I think we're at. Again, I use the VIX as a leading indicator in terms of if we're in a bullish or bearish market. I use the VIX to determine when I should buy when the market sells off. Now, a number of my younger students who, I taught the VIX and understand and started learning about the VIX, they said, well, if the VIX penetrates the lower Bollinger Band, I'm going to short the market. Do not do that. Separate the VIX into two distinctly different calls. When the VIX is running and penetrates the upper Bollinger Band, that's a signal to buy the market. Just buy it, the S&P. Now, when the VIX is running and penetrates the lower Bollinger Band, just sit there, watch it, and smile. Because the VIX can run on the lower Bollinger Band for several weeks, several months. If you look back on the left side of this chart, you can see where the VIX ran on the lower Bollinger Band for several weeks. So the lower Bollinger Band for the VIX is not a good market timing, but the upper Bollinger Band in terms of when to get in is. So right now, all I'm saying, I'm not trying to time the market. I'm just saying that we are in an overall bullish market. All right, that's the VIX. Now, I do have some other charts here, so I want to go over these real quick. These are stocks that I own, I've been trading, and we've talked about. Now, it looks like this one is, which it is PLTR, PLTR. So bear with me a second, I'm pulling up the chart, a bigger chart so I can see it. Come on, where are you? Bear with me 1 second. Now, the stock has made a tremendous move since we last spoke. All right, stock is actually went above $30 a share today. I'm not sure where it closed at. I can pull it up, but that's not the key here. So here's a couple of questions I had. One is, Professor Milligan, I missed the breakout. This thing is running so much, I want to buy it here. I understand. Been there. You're sitting there, you're watching this thing trade, and the whole time it's trading up, you're sitting there saying, why I had this, and I don't know why I didn't pull the trigger. Here's my comment to you. Do not chase any stock. All right? Don't get me wrong here. You know I buy them when they go through the highs, but don't chase them. My rule of thumb is when a stock does break out, don't pay more than 10% above your breakout point. So if your breakout point is $20, 10% above 20 is going to be 22. If your breakout's $100, you can pay up to 110 for it. Again, 110, 111. This is not really this is not a mathematical fine line. It has to be 110 or exactly 10%. What I'm trying to get you to do, though, is understand I'm not paying 20, 30% above a breakout. Now, if you look at PLTR, here's what I expect to happen. If you look back, early November, you saw the stock traded between $14 and $16 a share. Then it broke out. It has some more consolidation between 18 and 19. Then we have another breakout. So for my clients here, my students here who like this stock, and I like it, this could be a long-term hold for me. I would wait for the pullback, and there's going to be a pullback. So let me come off of this real quick. There's going to be a pullback, all right? When that pullback happens and consolidates, not just a pullback, you want to see a pullback consolidation like we saw between 14 and 16, between 18 and 20. When you see that consolidation and then the stock breaks out from there, that's your next entry point. For me, during that period of consolidation and the next breakout, I'm going to add to my position. I don't believe in dollar cost averaging. I don't believe in buying stocks that because they dropped. I don't believe in adding to that. Because stocks that drop can continue to drop. You don't know where the bottom is. So what I do is when the stock does consolidate and goes sideways On the next breakout, I'll look to add to my position. So I actually I end up buying more stock at a higher price. But I keep doing that. That is what a momentum trader will do. That's what a momentum trader will do. That's what a trend trader will do. So I'll add to my position as it moves up. I do not add as it goes down. When it goes down, I'm sitting there looking and saying, should I pull the trigger? When should I pull the trigger? All right, so that's what's going on right now with that stock. Another one I want to pull up, and let me just make sure I got which stock I have up. Come on. All right, so now you're looking at, bear with me a second. You're looking at CRSR. CRSR broke out. Actually, it broke out down here above 22, 23. Then it consolidated and traded between 24 and 28. Then it broke out from 28 and basically ran from 28.29 to where it is right now, getting as high as $52 a share. Again, anyone that's looked at technical analysis knows when a stock makes this kind of run, there's going to be some retracement. There's going to be profit taking. Plan for it. It's going to happen. One of the things that I talk about is the Fibonacci's. Now, understand this. I'm not into names. I learned this technique, it's not even a strategy, but I learned to read charts, and then I learned about the Fibonacci's. Bottom line is this, let me sum it up. When a stock makes a move like we've seen to the upside, straight up for several days, unless there's some news of a takeover, something like that, if it's just nothing but investors wanting to own the stock, institutions pushing it up, expect a 50% retracement. Let me say it again. Expect the stock to retrace, consolidate, trade sideways, and then break out again. So during the period of consolidation, I'm watching. Now, if it breaks below that consolidation, maybe it's time to get out. I'm never going to sell at the high. But if it doesn't break down and it consolidates and breaks up, I'm going to add to my position. This is how you take a winner and ride it. Now, understand, on PLTR, I'm up over 100%. On this stock, I'm close to being up. I'm not sure. On this stock, I think I'm at 24. So yeah, I'm up almost 100%, over 100% on this stock. There's several stocks I'm up big on, and the reason being again is I expect the pullback. They're quality companies. They're new issues. This is my new issue strategy. I mean, this is it to a T. All right, let me move on to a couple others. This is Unity Software. I think that's the name of Unity Software. It's Unity. Unity, I'm not sure. I'm looking for it now. It doesn't have the name, just has a symbol. All right. I believe it's Unity Technology. UNITY, symbols U. Thank you, Alex. PLTR's having a new breakout every day, day through right. It was 16, 18, 23, 23.90. Yes, so you're looking at that. Now with the breakout you just had again, you want some consolidation. You really do. You want this thing to catch your breath. No stock is going to go from, and I don't know if the stock's going to 100, so don't get me wrong here, but no stock goes from 0 to 100 or 10 to 100 with not having any pullbacks, retracements, any consolidations. So if you're the kind that gets nervous that the stock makes a run like this, my advice to you is get unnervous, especially if you want to hold winners. Funny thing about winners, if you think about it, if every time I challenge you to think about this, and my students have heard this before, if you sold the stock every time that you entered, every time it hit a new high, then once you sold it off the new high, you're done. You're out of it. I know you're going to say, well, Professor, I'll buy it back on weakness because that's what I do. And I'm telling you, you never buy it back on weakness. You just don't. And if you do try and buy it back on weakness, who said that the stock's going to come back? So my only point in saying all this to you is this, is that you want these stocks to consolidate, just like we want the market to consolidate. And when these stocks consolidate, understand this from technical analysis, that consolidation is forming a new support level. You want to see it form a new support level. That's going to strengthen it. If it does not form a new support level, the pullback is going to be very vicious. So I'm looking at Unity now. You can see it. This one has it. So let me switch these up. You can see it. Stock runs up. So off the IPO, stock runs up to 100, pulls back to 85. Goes back to 100, pulls back to 85, goes back to 100. Then it breaks through and goes to 110, pulls back to 95. Then it pushes up and goes to 120, pulls back to 100. All right, this is a prime example of a stock that's running and backing and filling. My advice to you on this is this. Look for the back and fill, step in, buy it, put your stop loss in, and let it go. Wait for the consolidation. And then the other stock I have up here for you, I had three. Let's see, I did that one. I did Plantier. Okay, cool. And the last one I have for you in terms of stocks that we've already talked about, let me switch this up so you can see the full picture, is Snowflake. Now, I had told you this, and I keep saying it. Snowflake has made a really nice run these last, 2 weeks. Stock was as low as, looks like about 235 and ran to where it is now, 304 is last I have. I'm not sure where it is now. I can look it up, but it doesn't matter, 304. So you had a nice move. You can see that there's been a lot of backing and filling, consolidation, moving sideways. But for me, again, I think it's going to be a great company. I think I'm going to make a lot of money with this stock. But for me, the number is 319. When the stock gets through 319, you can see it on the chart. If you look to the first day of trading, stock trade up to 319. When the stock gets through 319 and breaks through that on the breakout, I'm all over it. I'm telling you now, I am all over it. All right. So that's one I like. You're probably wondering, Professor, if you like it so much, why didn't you buy it down here on the dip? One, I don't know how low it can go. Two, my strategy is not always right. I wish it was. Three, I've been involved in companies like this before. And it can take them, for those who want to look, it took Alibaba almost a full year. Actually, it took it longer than a year to run up and break through that initial trading high off the IPO. And that was, it ran to 120. And then it took almost 2 years to get back through that 120. During that 2-year time period, yeah, of course, the stock trade sideways, went up and went down. You could have traded it. But for me, as I told you, I like stocks on a breakout, one. And two, I like stocks that, my screen just went blank. My foot must have hit something. Who knows? But I like stocks that are actually taking out their new high. And then once they take out their old high, there's no resistance above it. So I'm willing to be patient and wait. I've done this before. Be patient, be patient. I'm just telling you guys, do not sleep on these IPOs after they become public. And in fact, the hotter the IPO, typically the more run you'll get when it finally does break through the old high. When it does. Now it could take 6 weeks, 6 days, 6 weeks, 6 months. All right, but when it finally does break, it's big. All right, so that's those are the stocks that I'm actively involved in. Those are stocks I'm looking at. I do have some other strategies I want to go over, but I don't have time now. I'm going to put them together. So the thing I'm looking at now for you guys is, I've had some questions on this. So I'm going to answer 2 questions. The first question I'm going to ask that I got was, and again, it goes back to knowing the rules. I've gotten so many questions on how to trade options. And that's when I go back to, if you don't know the rules of the game, you're doomed to fail or lose the game. So a lot of you want to trade options, but you don't understand how to trade options. So I am going to go through today and talk a little bit about what an option actually is. Some of you might find it boring, but again, some of you might find it helpful. I can't tell you how many times I've had people say to me, I lose money on options, trading options. I say, okay, how's your stock picking ability? How are you doing when it comes to picking stocks? And they say to me, well, I'm about, and they politely put it, I'm about 50-50. I do a decent job. And I'm like, seriously, tell me your biggest winners. So all I'm leading up to is that my experience has been that most people that don't trade options or do well in options is because they aren't good stock pickers. If you can't pick a stock that's going to go up or go down in a certain time period, options are just going to do nothing but help you lose money even faster. Not trying to scare you. Really not. I trade options. I use options. I just want you to understand options. An option itself is not a security. All right. It's a derivative contract. All right. All right. So let me just read this. Actually, let's go through a call. A call gives the owner of that option the right, but not the obligation to buy the underlying asset. Let me say it again. A call gives the owner of that option the right to buy the underlying stock at a predetermined price up to a predetermined date. Now, where a lot of you getting confused is you don't understand options are contracts, which means there's two sides. There's a counterparty to this. There's two sides to the contract. So if you're buying a contract, there's someone on the other side that is selling you that same contract. All right. Now, when you hear about people losing all their money and then some, make sure you understand this, losing their money and even more than what they put into the investment on options, 99% of the time it means that they're writing an option. So I'm going to attempt to explain to you, and for those who want to jump in, feel free to jump in. Brian, I don't put a time frame on when I expect the stock to meet a certain price. I just don't. I've learned a long time ago that, I can't, say this Friday, next Friday. I just look. That's one of the reasons why I wait for them to break out and go through their old high. For all we know on Snowflake, it could reach that 319, 310 level like we've seen on some other stocks, and then basically have profit taken and pull back and not break through it the first or second or third try. So I'm patient. And then think about this. You're sitting in Snowflake waiting for it to make its move. And in this case, it worked for you. But it doesn't always. If you're sitting in Snowflake waiting for that move, there's so many other opportunities that you missed. That's my big thing. How many opportunities did you miss while you were waiting for this stock to recuperate or do what you expected it to do? So I don't try and time things. I look at the market. As I lovingly say, I stay in the moment. Stay in the moment when you look at the market. Stay in the moment. Be forward-looking. Stay in the moment and be forward-looking, right? Stay in the moment, ProfessorMilligan, be forward-looking. Do both. But the one thing you don't want to do is look backwards. The one thing you don't want to do is sit there tied into a stock that's going up or going down, going sideways when you're losing out opportunity. All right, going back to options. So let me put this up. I know it's hard to see a little bit, but I'm going to talk about the red line. All right. The zero line, all right, I'm not sure if this is, so I'll deal with it in a minute. So let me finish this. So the red line is a call buyer. That means this person brought the call. I'm only dealing with the red line right now. The X is the underlying asset, the stock. Now, the reason why, if you look on the far left to where the Y-axis is, you'll notice that they have a negative against the C. That is the premium you have to pay for the call. You got to pay for this call. You got to pay for the contract. All right? It's consideration. So you got to put some money up. So again, a call gives the owner of this call option, the owner, the right to buy the underlying asset at a predetermined price up to a predetermined date. So again, what you're looking at now is you're looking at the X-axis. On the X-axis, you're looking at the actual stock itself. The red line represents the premium. And as the stock price goes up, you'll notice that the red line starts to go up. That means this call is starting to make some money. When it crosses the X-axis, when it crosses over that black line, that call is at the money. What it means is now the stock has gone up enough to recuperate what you paid for the premium, for the cost, the consideration. If it keeps going higher, you'll notice that the red line goes above the black line. That's all profit. As the stock goes higher, the call is going to go up in price. Let me say it again. As the stock goes higher, the call is going to go up in price. Now, when that red line is high as it is above the black line, it's telling you that the call itself is deep in the money. So again, I know I'm redundant. I know a lot of you know this already, but I'm going to repeat it. The premium is right there. It's the red line underneath the X. That's where you lost. And that's the money that you're down. That's the money you spent for that call. If the stock goes down in price, you're going to lose all your money. But that's the most you can lose. Now, as the stock goes above the strike price, that call starts to make money. When the call goes above the black line, it means that the stock has risen up in price, that the call has gone up enough in price to recoup your premium that you paid for that option. And then everything else to the right is pure profit. Now, the reason why I like this, the reason why I did this, for you guys who don't understand options, there's another side to this. The blue line represents the person who wrote the call. The writer, the seller. All right, again, these are contracts, two parties. The seller on this contract, the most they can make is that premium. The money that you paid to go long the calls, the premium that they received to sell you that call. That's the most they can make. And as you can see, as the stock price goes up, though, for the call writer, they're losing money. All right? And if you look further to the right, you'll notice that blue line is symmetric to the red line. What the blue line's telling you is that's the money that the person who wrote the call is losing. Options are zero sum. Zero. They do not create wealth. They transfer risk. They transfer wealth. So for every dollar that the call buyer is making is a dollar the call writer is losing. The x-axis is the price of the stock. The y-axis is the profit or money that's either made or spent. The x-axis is the actual stock price and on the black x-axis. All right. Hopefully you guys got that. I'm not sure if there's any questions, but let me say, I'm going to go through it one more time. I know I'm redundant, but I'm trying to drive this home. If you're a call buyer, you are the red line. You're going to spend money on premium. If this stock price does not go up, it stays where that or goes down, you're going to lose all that premium. Just like auto insurance. You have no accident, you're going to lose all that premium. As the stock price goes up, the value of that call is going to go up. The language we use in the industry is that the call, a call is perfectly correlated to the underlying asset, or high correlation to the underlying asset. What it means is that they react the same. As the stock price goes up, this call becomes even more valuable. Now, for every dollar the call goes up in price, that's a dollar that you make, the call writer, the person who sold you the call, is losing. All right? Now, I got you, Mike Reed. Give me a second. I'll get there. Thank you for that. All right. Now, let me come here. Every option contract must have an expiration date. That's the date when the contract expires. Every option contract has a strike price. That's the price that you can call on a call option, call the stock away and buy it based on that stock price. Consideration of premium, that's what you pay to buy a call. That's what you receive if you write a call. Then the underlying asset on stocks is 100 shares. And you don't have to worry about quality. Quality comes into effect when you're dealing with commodities. On options, on equities, on common stock, each option contract is for 100 shares of stock. All right, now, we use here in America what's called American style options. What that means is, bear with me a second. What that means is this. At any time, you can exercise your call option. Exercise your call option means that you contact your broker and tell the broker that you want to take delivery of the underlying stock. All right? That means you're going to buy it based upon the strike price. Let's throw some numbers in here. Let's say that the strike price was $15. You had $1 worth of premium. So that means your break even was $16. The stock has gone to $20. You contact your broker and say, I want to exercise my contract, which means I want to buy those 100 shares at $15, my strike price. And that means you have to come up with 100 shares, you have to come up with your $1,500, but you own the stock. That is exercising your option. Now the other side is you don't have to exercise your option. Oh, let me back up. We use American style, which means you can exercise your option anytime you want between now and the expiration date. Anytime you want. The other thing I'm going to say to you is this. If you don't have to exercise your option, you can always just turn around and sell your contract. The one benefit about trading options here in the US and on these exchanges is that they're highly liquid, which means that you can sell them anytime you want. You can buy them and sell them. So if you have enough profit and you instead of taking delivery of the stock, you can actually sell your option, take that cash, and buy the stock directly yourself. One thing to take in mind, options have some very beneficial tax consequences for us. They're not taxed like stocks and bonds. So if you are trading options, you have some nice profits, make sure that your accountant understands the tax consequences. Now, I'm going to put up, which I am putting up. Come on, where you at? Oh, there you are. Let me switch it. Now, I gotta go back onto my iPad. I wear glasses for a reason. You can laugh at me if you want, but I can't see. I need to see it to explain it. All right. What you're looking at right now is I pulled this up intraday. This is Apple. I pulled up Apple stock because I just wanted to pull up something. I'm not making a recommendation, good or bad for Apple. I'm just telling you what's going on. So Apple is trading at $15 a share. On your left side are the calls. On the right side is the puts. Down the middle is the strike price. So there's a 114, 115, 116. The stock is at $115.92. So right now, the at-the-money right at-the-money strike price would be the 116. These options, this particular option I pulled up, expire in 2 days. You can see the date, November 27th. So if you brought the 116 calls, to the left of that, you'll see the bid and ask price. If you were selling, they're selling for 64 cents. If you were buying, it costs you 65 cents. Now again, this is for 100 shares. So take the 65 times it by 100, and this option will cost you $65. Now, your break even is the 116 price, the strike price, plus the premium 65. So your break even is $116.65 on this option. If the stock closes at $116.65 on Friday, you'll make your $65 back on the option. Everything above $116.65 is pure profit. Pure profit. That's on the call side. On the put side to the right of that, you'll see that again, at the 116 strike, you'll see that option, the bid is 73 cents, the offer is 75 cents. As you look to get more time, these options are going to have more premium. They're going to cost you more money. The more time you want in the option, the more they're going to charge you. So there's going to be a lot of time, as you go further out, more time, they're going to cost you more, which means your break even is going to be even higher. All right, those are calls. Now, understand this. You go out and buy this call right now, this one call, the 116 call on Apple, and the stock stays at 116 or goes down between now and Friday. This option is going to expire worthless, which means you're going to lose all of your $65. So one thing that people don't understand when it comes to options, you put up less money. But if you're wrong and this option goes against you, you could lose all your money. Now, understand this. If the stock goes to, between now and Friday, $125, remember our break even was $116.65. So that means at 125, you made $8,035 per option. You made $830 on a $65 investment. But here's what I want you to understand. The person who sold you that contract, the person who wrote that option contract, that call contract that you brought, the only money they made was the 65 cents, $65 on premium. But they lost all that because when you made the $835, they lost $835. Zero sum. Whatever that person lost is what you made. Whatever you made is what that person lost. This is the reason why options are not, repeat, options are not something to go into if you don't understand how they work. Once you understand them, they're a beautiful thing. Now, let me add a couple things to this. The real key to making money in options, as far as I'm concerned, if you're buying calls and puts, you're going long calls and puts, you're a buyer. And by the way, I recommend all of you guys be buyers, you newer people, until you really understand what's going on. Because as a buyer, the most you can lose is what you invest in an option. All right, but the other side is I don't recommend you guys write contracts until you fully understand how these contracts work. All right. And again, your ability to pick the underlying asset and its price movement over a time period is where you're going to make your money. Now, there are a lot of people out there, and I'm gonna wrap this little segment up soon. There's a lot of people out there that will tell you that it's okay to write options. And the reason why you would write an option is to collect premium. Since most options expire worthless, is to collect premium. Real quick story. Gentlemen I know, every Friday morning before option expirations, because options expire basically Friday, options actually expire on Saturday. The reason why they'll say Friday is because no one's trading options on Saturday unless something happens. And here's the case. Friend of mine, every Friday, he would go out, he would write some options for nickels and dimes, expecting the stock to expire worthless. And he'd make himself a couple $100. You know, he would do it a couple $100, whatever the case. He would do it every option expiration on that Friday. He'd write the options, collect the premium, and go about his business. One day he wrote some calls on the stock. And again, he's writing. And if you're writing calls, it means you're bearish to the underlying asset. You think it's going down so you can keep the premium. You don't write calls on a bullish asset because it goes up, it's going to get called from you, you're going to lose money. So he wrote some calls on a stock that he thought was going to go down. At least go down for that day and stay down so he can make his money. Well, lo and behold, that Friday, after the market closed, the company got a takeover offer. He was writing calls. He got a takeover offer. And by the way, he was on a train on his way from New York to D.C., so he wasn't even able to do anything when this all happened. This was before cell phones and online trading. Long story short, they opened up the exchange on Saturday, traded the options. He lost more money than he ever had. He lost all the money he had made over the years in terms of writing calls on options. He lost all that and even more, to the point where he worked for a brokerage firm and they told him, he have two options. One, you can write us a check for the dollar amount you owe us, or two, you can just work it off. You work for us, you just keep, you're working here, you got to work it off. So he had to work it off. It took him, he said it took him, about a year and some change to work it off, but he worked it off. Only reason I tell you that story is to tell you this. If you're writing options and you don't know what you're doing, it can become very painful. All right. I'm trying to think. Oxymoron, trying to think. I'm going to save the puts for next week. I'm going to save the puts for next week. I'm only going to save the calls. But I do want to, and I'm going to say it again. I'm going to put it up and say it again just because I have to. If you're buying calls, you're bullish the underlying asset. That means you're buying calls because you believe the stock price is going to go up and that you can sell that call for more than you pay for it or call the stock in at a cheaper price than where it is in the marketplace. So if you're buying calls, you're bullish. If you're writing calls, you're bearish. If you're writing calls, you believe the underlying asset's going to go down in price and you get to keep the premium. All right? That's what you're believing. So you're bearish the underlying asset. You think the underlying asset's going to go down in price during the time frame of your contract. If your contract's 2 days, you think over the next 2 days the price is going to go down. If your contract's 6 months, you think over the next 6 months the price is going to drop enough that you can actually make a profit. All right, that's a call, that's a put. Now I'm going to leave this and we'll come back to this some more on another day. Now, another question I had real quick. I'm just looking through and make sure I answer the question I have about trading range and stocks. All right. Another question I had, some of you guys can help me with this, but another question I had was for a newbie asked me, where should I open my account? Where should I get my account? So I say a couple things. I've had accounts at a number of firms on the street. Over the years, I've had accounts with at almost every major brokerage firm on the street at one time or another. Actually, not even one account, but several with almost every major firm on the street. But the only reason I mention that is this. One is you gotta, and I know it's hard because you're new, but certain brokerage firms have specialties. So, case in point, I know you guys are going to Robinhood. Not a problem. Great place to start. No commissions, so you don't have to worry about being chewed up by that. The challenge you have with, you can call them obnoxious and make them place trades for you. The challenge you have with Robinhood, though, is two things. One, you can't short stock in Robinhood. All right, so you cannot short stock in Robinhood. Yes, on a small account, you can use Robinhood. So don't, please, again, I'm not saying good or bad. I'm saying on small accounts, Robinhood is a great place to start. The downside to Robinhood is, you cannot short stocks. And also, there are some limitations in terms of the option strategies that you can use. Nothing against Robinhood. Great place to start. Charles Schwab, TD Ameritrade. I haven't had a Schwab account in years, but I've had several friends that work at Schwab. Schwab does a good job. TD Ameritrade does a good job. You can trade any security. You can short stocks. You can trade options. You can put different option strategies on once you prove that you know what you're doing, so you can move yourself up. But again, how can I put this? If you're not trading options right now, in fact, I could even state this. Both of my children have had both of them at one point had Robinhood accounts. So I even had them there. I moved them, my daughter had to move for her job, but the reason why I moved them again is only because I could not short stocks in a Robinhood account. Just couldn't get short. And then the other thing too was try to put on certain option strategies and they just wouldn't let it happen. So I'm like, okay, not a problem though. Not a problem. I see a number of you put down TD Ameritrade. Again, I'm using them right now. Robinhood. Who is it? For the option traders, Tasty Trade. Tasty Trade, the founder of Tasty Trade is the one that's actually started Thinkorswim. Thinkorswim was a trading platform that I used years back. The gentleman who started Thinkorswim sold it to TD Ameritrade. So if you want to trade any type of derivatives through TD Ameritrade, you're trading through Thinkorswim. Now, the gentleman who started Thinkorswim has another firm he started called Tasty Trade. Tasty Trade is basically derivative oriented, which means they're on the derivative side. And the other thing about Tasty Trade, which is what some of the small firms have done, like Schwab and some other firms, You can buy fractional shares now. So if you don't have the $2,000 to buy Alphabet or whatever the case may be, you can buy fractional shares. So they all have that available. Speaking of this also, and I have a number of you guys on here. I'm not going to say any names, but one of the guys on here is one of the people, he might talk about it. But when I talked about the VIX running it down on the lower Bollinger Band, talking about how bullish the market is, this young man and I had a conversation, and he was short. He was shorting the market, expecting it to pull back because the VIX had penetrated the lower Bollinger Band. And after our conversation, he realized that, as always, I'm going to smile and I say, I was right, as always, and he was wrong. But the reason why I bring it up is not that he was wrong. He just didn't understand. I basically gave him some understanding. So again, right now, the VIX is signaling to you right now that we're bullish for the next 30 days. That the investors, institutional investors, the investors who buy calls and puts on the market, they're heavily on the call side compared to puts. And they think that based on their action, they think the market goes higher. Guys, the other thing I'm going to say to you is this, and this is just my thoughts because I know it's come up. And I know President Trump, Richard, do you still, by the way, Richard, do you still want to come on and say something? I saw you earlier, you were asking to come on. Just let me know if you want to come on. I definitely. You were right eventually. The problem, so Richard, let me know if you want to come on. Ham, the only problem, which is why I talked about with you eventually being right, is it's about timing. It's about timing. And the VIX can run on the lower Bollinger Band for several weeks. I mean, you can miss some major bull runs in the market trying to use the VIX to determine when to get in and get out of. And if I remember correctly, I think you missed a couple of days, couple of weeks in there of bullish move in the market. That's all I was trying to say. And Ham, you're like me. I'm never wrong. You know, it's the Vince Lombardi statement. Vince Lombardi said, I never lost a game, I just ran out of time. I feel the same way. I've never lost a trade, I just ran out of time. There was one other thing I was going to say, and I forgot that quick, so evidently it wasn't that important. Ham, I'm leaving it alone. You can put the numbers out there. I don't know what the numbers are, but you can put it out there. But the one thing I'll say to my Arminator is that we've all made bad trades. We've all lost money. So if you guys think that you can actually do this thing and not, lose any money, you're kidding yourself. It's like, the analogy I give is like walking in the rain and talk about you never got wet. It's just not impossible if you're trading these markets. So I forgot. There's something I was going to tell you guys. Oh, well, can't remember. I'm getting old. Oh, I know I was going to tell you. There are a number of IPOs to watch in the marketplace. A number of them. I've had a couple people ask me during the week about some stocks, and there's a number of them out there that actually IPOs that are actually trading really well. One of the things that the downside for me, and this is me, as I mentioned, I'm not a big biotech guy. I just don't trade biotechs, but there's some biotechs that are just straight out running, and I'm not talking about I'm talking about the new issues come out and they're just running. And don't forget though, when these things break syndicate bid, because I'm going to talk about that next. When they break syndicate bid, you definitely don't want to be around. Syndicate bid is the IPO price. If it breaks the IPO price, you don't want to be around. All right, it's 10-2. I'm going to wrap this up because I want you guys to have a great Thanksgiving. Go out there, eat a lot of food, stay healthy. Social distance, stay healthy, but enjoy your Thanksgiving. We got a lot to be thankful for. I just reminded myself what else I was going to say. Do not get caught into this trap that if there's a Democrat in office, the stock market's going to do well. If there's a Republican in office, don't get caught in all that. That's just, they're selling newspapers. That's hype. Don't get caught in that. Just stick to your fundamentals. Just let the market talk to you. Watch the VIX. Watch the market. Watch your stocks. There's certain indicators, But don't be fooled by the press and the hype. All right, just don't get sucked into all that. Let the markets talk to you. One of the downsides to our industry is that everyone has an opinion, and now there's a forum that they all can put it out there. Like me, I'm putting my opinion out there. It's a forum that we all can do it. The one thing I'm going to say to you guys is be patient, watch, and form your own opinions. You'll be surprised how smart you are. You're a lot smarter than what Wall Street's giving you credit for. Use your common sense. All right, I'm about to hop. I do appreciate you guys. Have a wonderful, wonderful Thanksgiving. Oh, one last thing. One last thing. During holidays, Thanksgiving, which is Friday, Christmas, New Year's, during holidays, you're going to notice that volume's going to drop. Volume's going to drop, and things will be, exaggerated to the upside and to the downside. Hey, Daisy, long time no see. Give me a call. I haven't talked to you. One of the things is, as you see these markets move up and down during the holidays, they're going to move either further up or further down. Stocks move further up or further down off a light volume. So don't read into it too much. Don't worry about it. It's light volume. And if your stock does sell off on some light volume during the holidays, most likely it will bounce back. All right, guys, I'm out. I do appreciate you. Now I'm going back upstairs and into my kitchen to finish my cooking. I will see you next week. All right, bye-bye.